What is insurance capacity? Why would someone want IUL if they're already mega wealthy? Get ready. In this episode, you're going to be blown away. When you begin to understand insurance capacity and why it's an asset and that other people may want to utilize it, charities, your children, or capacity that you think, well, why do I need any more life insurance? I have all that I need. You maybe don't know what you don't know, so get ready. I'm Doug Andrew, and I've been helping thousands of people now for 5 decades optimize their assets and minimize taxes, empower what I call their authentic wealth. Now, when we talk about asset optimization, that means you're increasing the liquidity, safety, rate of return, and the tax benefits on underperforming or non-performing assets that do not pass that liquidity, safety, rate of return test with flying colors. It's called the L.A.S.E.R test. See, L.A.S.E.R is the title of my book, but the L.A.S.E.R fund is a properly structured max funded IUL. It stands for liquid assets safely earning returns, okay? Totally tax-free returns. When you structure an IUL policy to be used as a living benefit, much more than the death benefit, which is what E.F. Hutton designed it to be used for, okay? They're the original brainchild behind the emergence of universal life in 1980. And indexed universal life came out in 1997 so that you could still get a great rate of return even if the stock market was going down. That's called indexing. It's not an index mutual fund. So to put it in a nutshell, people would come to me not necessarily wanting or needing life insurance protection to pay off when they died. That sort of came along for the ride. What they wanted to do was reposition underperforming or non-performing assets that they wanted to increase liquidity, safety, rate of return, and the tax benefits, because a properly structured IUL policy passes the L.A.S.E.R test with about double the score that most investments score with those 4 criteria. These are the pillars on the front of the book. And you can score any investment on a scale of 1 to 10 based upon liquidity, safety, rate of return, and the tax benefits. And nothing else comes close to a properly structured max funded IUL, a L.A.S.E.R fund, okay? So let's talk about how you then apply and get approved. You're going to submit applications to the proper insurance carrier that have the proper products, and that's why you should go to a certified IUL professional to do that. Because out of thousands of insurance companies, there's only about 80 that even offer IUL, but I wouldn't put my money in 70 of the 80, and there's only about 10 that I would put my money into, and there's only certain products based upon certain objectives, okay? And so if you're going to apply, they're going to go through an underwriting process. So I cover this in other episodes, but let's do a quick synopsis of this. I have to qualify based upon my health. Those are called medical underwriting guidelines. Am I healthy enough to qualify? But if even I get rated, I can still squeeze down the death benefit so it performs really well. It doesn't matter how old you are or how unhealthy you are. If you can qualify, even with the rating, you squeeze down the death benefit so that your rate of return is the same as a 25-year-old. You earn, like I have, 11% average, and you net 10 cash on cash, so that $1 million that grows in there can generate $100,000 a year of tax-free income, okay? So the cost of insurance, when you do it right, actually will get cheaper as you get older. And there's a lot of agents that don't understand how to do what I just said. So watch other episodes to understand this. Now, the other is financial underwriting guidelines. That means insurance companies will not just approve you for $1 bazillion of life insurance because you are applying for it, okay? There must be a reason and justification for the amount of insurance applied for. First of all, if the insurance is on you or whoever it's on, because the owner, and you can own a policy on somebody else, a surrogate, okay? But when you take out the policy, the insured, if they were to die, why would the beneficiary you're naming in the application suffer an economic loss equaling $5 million or whatever the death benefit's going to be. You have to prove insurability or insurable interest, the relationship between the insured and when they die. Why would the beneficiary need this money? How are they going to suffer that loss if they don't have this insurance policy? Okay, that's called underwriting. Now, this arrives at what we call insurance capacity in a way, because when you're older, instead of qualifying for insurance based so much on income, because when you're in your 30s, when my wife and I were in our early 30s and we had 6 children, pretty much without question, you can apply for 30 times your income. And so what I was going to say is that 30 times my income, if I was making, $100,000 a year, they'll approve me for $3 million of life insurance, because it would take $3 million if I die to keep my wife and my children in the same lifestyle with a cost of living factor throughout the next 60 years that my wife might live, and my kids will grow up and become independent on their own. But later on, if I was 60 years old, they may only approve me for 12 times my income, because now if I die, my wife only needs money for 30 years, not 60 years, and she doesn't have to worry about dependents. Hopefully they're independent, okay? And so that's called insurance capacity, if you're calculating how much life insurance can you justify based on a factor times your income. Well, when you get older, even though the factor times your income goes down, your income has gone up. So even if your insurance capacity is 12 times your income, maybe your income now is $500,000 a year instead of $100,000. And so there's a lot of capacity there. The other factor, if you are applying for more insurance than the income calculation, would be your net worth. And so if I have a net worth of $5 million, it's pretty much, I can apply for $5 million of life insurance. If I have a net worth of $10 million, I can qualify for $10 million of life insurance. That's called insurance capacity. Okay. Now, I have gotten people approved for double their net worth. That's in another episode where you can get certain approvals based upon certain criteria. Okay. Let's just go back to the simple example. Now, if somebody, let's say, had a net worth of $10 million, most people who have that kind of net worth, they don't need insurance because they have the money. So why? Why do they take out IUL? Well, they do it because when they learn about the merits of max funded IUL that allows you to accumulate your money tax-free, access that money tax-free at a nice rate of return, 8 to 10% payouts, and then when you die, it blossoms many times doubling or more. So what I usually do is simplify and I say to an older affluent person, so you have $5 million sitting here. Why would you leave behind? Well, first of all, until you die, why would you generate from $5 million? Why would you sit there and generate this much income in the market at 4%? Because that's called the financial services industry rule, 4% rule. Why on $5 million would you settle for 4% returns and payouts when you could get double that, 8%? Why would you settle for 4 when you could get 8 or 10? Tax-free. And, not or, and at the end of the day, when you die, why would you leave behind just $5 million in these mutual funds and these yet to be taxed IRAs or 401ks taking RMDs? Why would you leave behind just $5 million when you could leave behind $10 million? And they go, well, what do you mean? I go, because the life insurance usually blossoms. $5 million of cash inside this. Many times the death benefit is about double. So if I died, every million would blossom to $2 million within 3 weeks after I die. There's nothing else that does that. Okay. So why would you generate this when you could generate this? Why would you leave behind this when you could leave behind this? If it doesn't cost you anything, it's not free, but it's being paid for with otherwise payable tax that you would pay if you left your money where it's at. Affluent people get this, but most affluent people, even if they're repositioning assets, many times they don't use their full insurance capacity. If they've been meeting with estate planning attorneys or advisors, usually the estate tax, if they were to die, and if you don't know what I'm talking about, estate tax is the inheritance tax, and the thresholds for that change based upon who's ever the dominating party in Congress or the executive branch. And so tax revenuers usually like to tax people that are 6 feet under because they can't complain about it if they want more and more tax dollars. And so they will lower the thresholds of when estate tax starts out. And, you know, back in the 90s, if you died and you anything that you owned when you were alive over and above $600,000, the estate tax started out at 37%, and then it topped out at 55%. As of the recording of this episode, you have an exemption between a husband and wife. I mean, you have an exemption of over $10 million. But the current president of the United States wants to lower that back down to $5 million. So they want to lower the threshold of when the estate tax starts, and they want to raise the actual rate from 40% right now up to 67%, okay? So whatever it is, if there is going to be this estate tax, which is due within 9 months after the person's death, if both the husband and wife die, okay, there is no estate tax due on the first death if they're married, okay? But at the second death, oh yeah. And so a lot of times they would like to pay that off with life insurance proceeds rather than having to sell all of the assets or the business or the apartment complexes to sell the assets to pay the IRS half, okay, or more. And they want more now. The point I'm making is, if you have a savvy, wealthy individual and they are trying to have their estate taxes paid from life insurance proceeds, which is very smart because it's discounted dollars, usually the most is 50% up to 67% because that's the highest the estate tax has been recently, okay? Well, what does that mean? They could qualify for $10 million and they're only taking out $5 million. That means they have $5 million of insurance capacity they're not using. Now, the first thought is this: well, if I don't need it, why should I pay for something I don't need? Because they're thinking it's going to cost them. So I say, okay, stop thinking about what it is. Think about what it does. What does it do? What does max funded insurance do? It accumulates your money tax-free that you put into it. And you can access and get 10% a year tax-free out of that thing. It creates tax-free income, better than anything else I know. And at the end of the day, it increases in value and transfers tax-free. It doubles your money. So that's what it does. Oh. So even if they don't use that capacity, somebody else can use it. So when we talk about capacity, many times affluent people say, ooh, I get it. Yeah, if I can generate double or triple the cash flow and rate of return the rest of my life, and I can also leave behind twice as much as leaving the money where it's at in these apartment complexes, why wouldn't I do this? And I go, exactly. Why would you generate this when you could generate this the rest of your life? And why would you leave behind this when you could leave behind double that? So look at what it does. Now, let's say they still have capacity. So I'm going to give you two examples of this. Once there was a small community where I live that we're going to build a new senior citizen center in town. And they were going to tear down the old church that had been in town there for years and build a new senior citizen center. Well, there was a lot of old timers in town, the farmers. They didn't want that church to be torn down because that's where they were baptized. It was nostalgic. But the architects said, well, it's not feasible to bring the old church up to current code with electrical and plumbing and heating and all that stuff. It's going to cost an extra $5 million to turn the old church into the new senior citizen center and bring it up to code. And so we're just trying to save $5 million. If you old farmers in town would ante up $5 million in donations, we'll do it. Okay. Well, these older people, a lot of times they were what I call land rich, cash poor. They had been there for years, maybe a second or third generation landowner inherited this property, and they have 30 acres, 300 acres of dirt behind their house. Well, they may not even have $50,000 in the bank. But the IRS says, when you die, we're coming in for estate tax, and we're going to, that's worth $3 million. That's worth $5 million because there's development all around you there. That's what you're worth. Well, I don't have any money, and but nonetheless, that's what it's worth. But they don't want to sell it. Well, if that's what they're worth is $3 million, they qualify for $3 million of life insurance, no questions. And they go, well, I can't afford even $1 million of life insurance. Who said you had to afford it? Now, you want to donate to the Senior Citizen Center. I said, how would you like to donate your lives to be insured? So what you do is you take out $1 million or a $3 million life insurance policy, and there are financial institutions, banks mostly, that will premium finance. They'll finance the premiums on this $1 million or $3 million policy. You don't have to pay any premiums. You are borrowing, basically, but you're not on the hook to pay it back. You're borrowing money you don't have to pay back. It's going to be paid back when you die. So the lending institution loans you, I don't care if it's $50,000 a month, $100,000 a month, and this loan just accrues with interest. It's not exorbitant interest, a nice interest rate. Why would the bank do that? Because they have a collateral assignment on that life insurance policy. So if they're loaning you $100,000 a month and it's accumulated with interest, and all of a sudden, and it wouldn't be that expensive, it might be $50,000 a month or whatever, but when you finally pass away, they have a collateral assignment, a lien on your life insurance. So when it pays out $3 million, they will get back all of the money they paid into the policy plus a nice interest rate. They get a nice rate of return. And the rest of the death benefit goes to the charity because you're naming the Senior Citizen Center as the beneficiary. So enough of you do that, and all of a sudden, the Senior Citizen Center can float a bond that they paid back the extra $5 million inside of the bond. They get a bond that they can pay off in the next 15 years, and where are they going to get the wherewithal to pay that? From your life insurance when you pass away. Because all you farmers have life expectancies of probably only 10 to 20 years. So you'll have your name on a plaque as a major donor to the Senior Citizen Center, and you didn't have to cough up one dime out of your pocket. You simply donated your life to be insured because you had a capacity you weren't using. Did any of you get an epiphany there? Let's go one step further. Years ago, I had some capacity I wasn't using. And, I had this heart-to-heart conversation with my children. I said, kids, regardless of what you may think, if you think that Dad's immortal, I have news for you. I'm not immortal. I'm going to die someday. Now, the reality is this. I will likely pass away sometime between now and age 100. I have some insurance capacity that I'm not using. I want you to use it. Now, I'm not going to pay the premiums. I could, but no, they have to have skin in the game. I want all of you, let's say, to take out $1 million life insurance policy on me. You're the owner, you're the premium payor. And you can maximum fund it and get all the tax-free income and tax-free growth because you own a policy on me. But you can minimum fund it. Now, to minimum fund it back then, I was in my mid-50s, would be $500 a month. You could put in $1,000 a month, but do the math. If you put $1,000 a month into $1 million policy on me, you would have to be earning a 12 to 14% rate of return, so that by the time you retired 30 years down the road, you have to do that for 30 years before you would net $1 million after tax out of an IRA or 401k. I would not recommend you use an IRA or 401k. In fact, I said, I'd shoot you if you did that because you know better, and they don't. They use IUL. But the point is this. If I die anytime in the next 30 years, they're going to be an automatic millionaire within 3 weeks. I tell them to try to look down and look sad at my funeral because they're going to be See, I basically said I want you all to be millionaires within 3 weeks after I die. But I'm not giving you the money. You're going to use your money. You're going to put in, $500 a month or $1,000 a month, and you will own $1 million of life insurance on me because it's capacity I'm not using. And then whenever I pass away, that $1 million is tax-free. And that $1 million could generate $100,000 a year of tax-free income by putting it back into your own IUL policy. It's like, do the math. Quit looking at what it is, look at what it does. This is why I have owned life insurance on my father, on my father-in-law, on my mother-in-law. I could not own it on my mother. She already had heart issues. She was uninsurable before I did. It has allowed me, because 2 of them have passed away, to have the wherewithal to help those survivors. We've been able to help my mother-in-law with the death proceeds of the life insurance proceeds I had on her husband, my father-in-law. It was one of the best investments ever is to own life insurance on my father-in-law, the proceeds of which has allowed us to be able to then give help and assistance to my mother-in-law, which the other 5 siblings haven't been able to do. So look at what you do. That's insurance capacity. Hopefully you're getting insights here. So if you want to learn more about max funded IUL, I would recommend you claim a copy of my book, The L.A.S.E.R Fund. It's 300 pages, jam-packed with information, charts, graphs, and what have you. It's actually 2 books in one. 200 pages contain all of the left brain learning. If you're a right brain learner, you learn by stories. You flip it over to this one, and there's 62 actual client stories on this side. Now, this retails for $20 on Amazon, and if you buy it on Amazon, thank you. But I'll gift you a copy free. So you click on the link below, laserfund.com, and when you go in, I require some skin in the game. You contribute towards the shipping and the handling. I'll cover the rest of that, and then I'll pay for the book. I will fire out a hard copy to you via priority mail. When you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video options there too. But I want you to take advantage of a quick consult because you'll be able to schedule an appointment with a certified IUL professional. And that certification is not easy to get. We created it. It's a 100-question proficiency exam that takes hours and hours of training. And you cannot become certified if you only get 95%. You have to get 100% correct on the exam before you're certified. And so for no cost or obligation, you can ask them questions. They can create illustrations to show you how a properly structured IUL would work in your particular set of circumstances. And I would recommend you do that. And then if you implement it, make sure it's implemented correctly. You can use them, but you don't have to. There's no obligation. Is that fair enough?